When we think of a routine, we often think of the mundane, those common chores and tasks, stuff that are, well, frankly, sleepy.
However, the start of 2016 has been anything but sleepy, and while it is likely that volatility will remain with us for the foreseeable future and market risks have certainly increased, we continue to see as the most likely scenario that the economy will avert a recession and the market will close the year with volatile yet routine investment outcomes.
But the true value of a routine, helping us plan ahead and keeping us focused, may be as valuable this year as ever before. LPL Research's Outlook 2016 is here to help identify the good habits and routines to help navigate what is likely to be a volatility-filled year that will be anything but routine. Any good routine starts with the basics, and for investing, that is understanding where we are within the economic cycle. A quick check of our cycle clock suggests that we are in the mid to late stage of the current expansion. But identifying the exact time of the economic expansion isn't that easy, as we are still seeing some early cycle behavior, such as loose monetary policy, inflation, and employment growth, as well as some early signs of late cycle behavior, namely corporate profits. But when taken in totality, it appears that 2016 may be the first typical mid-cycle year of the current economic expansion, and thus requires a shift to the new mid-cycle investment routine. We believe the U.S. economy, as measured by real gross domestic product or GDP, will get back to routine and achieve growth at 2.5% to 3%. It should be supported by larger roles by manufacturing, business capital spending, and net exports, and continued outsized contributions from housing and consumer spending. We expect continued progress in the U.S. labor market, with the economy generating more jobs and wage growth continuing to accelerate. Inflation remains in check, but may be poised to make a comeback. If oil prices move up as we expect, overall inflation may accelerate quickly and be well over 2% by year end. If so, this will add further credence to the Fed's decision to have begun its interest rate normalization path. It is important to remember that the start of the Fed rate hike does not signal the end of economic expansions. Since 1950, the start of rate hikes meant the economy was not near the end of its expansion, but merely at halftime of the cycle, with much more economic growth to play out. We believe that economic growth outside the U.S., in both developed and emerging markets, is likely to accelerate modestly in 2016, with the role of commodities a key differentiator. The Eurozone and Japanese economies are set up for continued growth, and we believe China will post growth in the 6 to 7% range, thus avoiding a hard landing. Turning to stocks, given our view of the economic cycle, we observe we may be in the no pain, no gain market environment, suggesting that any advances may require the market to build up its tolerance for volatility. However, despite the likely bumpy road ahead in 2016, we expect stocks to produce mid-single-digit returns for the S&P 500. Because we expect 2016 GDP growth near its long-term trend, corporate America should get back to delivering solid profits with mid to high single-digit earnings growth. Given the market's recent fixation with oil price movements, any stabilization in the energy space will go a long way to getting the market back to its long-term routine of focusing on corporate profits and fundamentals. One characteristic of the stock market that is customary, but certainly doesn't feel that way, is volatility. The correction experienced in the late summer of 2015 did not feel typical, but this type of decline is actually quite normal, even in positive returning years. In fact, the average annual peak-to-trough decline for the S&P 500 is 14%. Therefore, volatility is normal, and we expect volatility to remain with us again in 2016. In 2016, some routines may be more challenging than others, and sticking with bonds may be one of them. A limited return environment is likely to persist in 2016, and the year as a whole may look similar to 2015, with flattish return expectations for bonds. Three main challenges will likely keep pressure on bond prices in 2016: high valuations, steady economic growth, and the path of Fed rate hikes. Overall, inflation-adjusted yields, one of our key valuation barometers for bonds, remain very low by historical comparison and indicates the expensiveness of bonds. One element to watch is the gap between the Fed's and the market's expectations for the likely path of rate hikes. While quite far apart for much of 2015, the gap has narrowed as of late and indicates a likely gradual approach to the Fed's rate-rising actions. While maintaining the critical elements of your existing investment routine, like remaining goal-focused and staying committed to your long-term plan, we also need to embrace the new routine. As we progress into the latter half of the business cycle, a good routine will continue to serve as a steady guide as investors work towards their financial goals. But it will also become increasingly important for a good routine to be flexible enough to adjust to the changing environment. Let's summarize some of these new routines. 1. We believe equities are likely to advance, but we need to be prepared for lower than average gains from stocks. Modest economic growth and modest corporate profits in 2016 will likely just generate modest returns for stocks for the year. Large cap U.S. and cyclical growth stocks remain the primary building blocks for a strong portfolio, while emerging markets and developed international names may be worth adding. Avoid U.S. defensive stocks and certain bond areas such as long-term high-quality bonds, as well as developed international bonds, which may offer low yields with an expensive price tag. 2. Volatility is on the rise. With the Fed ending its zero interest rate policy in late 2015, volatility is likely to pick up. Emotionally challenged pullbacks, like what we saw in August and September of 2015, may become more frequent, even in an advancing market. 3. Turn down the noise. As volatility increases, being able to discern potential disruptors from the headline noise will become increasingly important. Our TVs and tablets often showcase headlines that will attract an audience, not necessarily on what is most important for investors. And smart investors will try to focus on actual underlying risk and tune out the noise. 4. Bonds still work as your best diversifier. Investment-grade corporate and high-yield bonds should be incorporated in your portfolio as they have historically held their value better during periods of rising rates and corporate balance sheets remain very healthy. Changing any routine can be challenging, but given the likely volatile nature of this year, adaptation is key. You have your financial advisor helping you to develop your routine with a plan like the LPL Research Outlook 2016 as you seek to make progress towards your long-term financial goals. Thank you for listening.